Hi, and welcome to Your Finance TV. We're here with Jeffrey Hughes, founder at Alpha Insights. Jeff published his weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. Jeff, welcome back.
Great to be here, Mehdi, as usual.
So, Jeff, I'm not sure what there's to discuss really after the Jets-Bills game last night, but for our viewers, make sure you like and subscribe anyway. But there's always something to talk about in the markets, right, Jeff? So why don't we kick off as usual with the top down?
Sure. Last week the S&P was down about 1.3%. I thought, there were a couple of noteworthy points to make, but we should also point out that this week we have CPI and PPI to look forward to, and those are going to be kind of the big, kahunas, so to speak. CPI comes out tomorrow, PPI the following day. Also, kind of an advanced payroll number. So, these are all going to be things that I think are going to have an impact on the market. Obviously, the inflation data and the trend of the inflation data has been down. The bulls have been leaning heavily on that. I think any disruption to that trend would definitely, put some pressure on the bull case. That being said, the dollar has been strong. 10-year bond yields have been holding up above 4%, around 4.3 right now as we speak. And WTI crude has been up. And so, I think you've got some tightening of financial conditions as a function of that. And I think that's another issue that the market has to contend with right now. We've been of the opinion that, the rally off the October 13th low last year was a counter trend advance. We think it topped in July. We think we've begun the next leg of the bear market to the downside, and we would not at all be surprised if the September-October time horizon delivers a negative surprise to investors and leads us on that path closer to new bear market lows. So, as such, we've been advising our clients and subscribers to remain patient, to minimize their net equity exposure and maximize cash reserves. And we continue to hold by that advice.
Patience, patience, patience. One thing that everyone is talking about is the rising gas prices at the moment. Why don't you talk us through your observations and thoughts on oil here?
Sure. In our weekly note, we published a slide that was entitled Houston, We Have a Problem. And that problem is WTI inventories are now at 46 days. That's the lowest in 4 decades and below the historical average of 65 days. And what's really the problem is that, the administration has decided that they're going to, continue to hold off on replenishing those. We've seen a couple of additions to reserves. I think some futures contracts were purchased and delivered in August to the tune of around 6 million barrels. There's another similar amount being delivered in September, but they have subsequently paused that replenishment of reserves. And so the problem is WTI crude oil prices remain around $88. And the Biden administration got into a game of chicken with OPEC, and OPEC decided that they were going to call their bluff. And they have, decided that they are going to curtail production and maintain that scheduled production cut of roughly 1 million barrels a day. And so, I think what is likely to occur is we're likely to see WTI crude oil prices persist in this, $80 to $90 a barrel range or higher. A breakout above 90 would probably give us a quick run to 100, and a breakout above that level could challenge the 2022 high of $130 a barrel or more. AAA national average gasoline price is now about $3.84 a gallon. We're paying $4.10 here in Minneapolis, and there's a well-known correlation that exists between gasoline prices and the University of Michigan's 10-year inflation expectation survey. And as gas prices approach that $4 per barrel range, inflation expectations start to move quite a bit higher. And they're currently around 4.5% for 10-year inflation average. And that is very tightly correlated on a positive basis to the 10-year bond yield, which continues to persist up here around 4.3%. So, our concern now is that, we've got this this we're experiencing these tightened financial conditions as a result of this relationship.
So, Jeff, could you expand on what you just mentioned there a little bit? Just the 10-year Treasury yields, US dollar as well, if you could throw that in, and then the crude oil prices and the correlation that's existing between them.
Yeah, so the correlation has turned positive between those three different variables, and normally we would see the dollar and rates pretty highly correlated under most conditions. Usually the dollar and commodities in general, but WTI specifically, would tend to have a negative correlation. There have been a number of occasions historically where the three of these variables have all been positively correlated. And in every such case, it has resulted in kind of this organic, tightened financial conditions, and tightened financial conditions tend to precede slowing economic growth. And this, I believe, is a problem for the bull case and for the economy, which we have contended for some time is on the precipice of a recession. And our view is that a recession will probably begin to emerge here in the late third quarter, early fourth quarter of this year, and persist into late 2024 if our calculations are correct. Another point, and this is at the risk of sounding hyperbolic, the same set of circumstances existed in the fall of 1987, which preceded the crash, stock market crash of 1987. I'm not trying to imply that these conditions are, indicative of that, but I'm also not ruling it out.
Oh, that's all very scary. We've been talking about the cycle composite again the last few weeks. Can we have a look how this is all playing out?
Yeah, as we've presented several times, Ned Davis puts together the annual cycle composite, looking at three different cycles: the 1-year seasonal cycle, the 4-year presidential cycle, and the 10-year decennial cycle. They aggregate those and equally weight them, and they come up with an expected path for prices throughout the year for the S&P 500, as well as an expected return for the year. And that expected return is about 10.5%. As all will know, the S&P has doubled that return at its peak in July. And so we are now in the period where the cycle composite is expected to trend to the downside between late July and late November. Obviously, there's some ebb and flow here. And what we thought would be interesting, and it's mostly because we like cycle data, we like to fool around with it and play with it. And, we found, some interesting correlating dates, okay? And we're big fans of the work of Paul McCrae Montgomery, a renowned cycle analyst who, had a 50-year career on Wall Street, making some of the most spectacular calls in history, including the crash of 87, since we mentioned it earlier. But, since we're kind of in this seasonally bearish period, and because the cycle composite has so many ebbs and flows during this, kind of downtrending sort of period, we decided to apply Montgomery's cycle turn dates to these. And as it turns out, there are 6 cycle turn dates, which is unusual, okay? There haven't been any for, I think, 3 or 4 months. And so we've got this kind of series or grouping of cycle turn dates. They come in around September 14th, which is this Thursday, September 29th, October 14th, October 28th, November 13th, and November 27th. Now, the September and November turn dates are minor turn dates. These are just one single cycle. The October turn dates are major turn dates, and those imply that there's a convergence of multiple cycles on those dates. The interesting thing is that those dates kind of correspond with periods in history where the stock market has been known to be negative, okay, and bottom, right? And so we're looking at those turn dates in October 14th and 28th as potential bottoming dates. And so what we've done is we've overlaid on top of this, schematic kind of our forecast, right? And we're just fooling around, playing. This is a possibility. This isn't really assured by any stretch. But what if the market tops here on this CPI data Wednesday, Thursday, the CPI, PPI data, and begins a downturn that carries prices down to substantial lows in October 14th, October 28th time period, at which point we get kind of a bottoming and a rally back into year end that carries the market to a closing return of 10.5%. So we've kind of implied that with our blue dashed line as being, kind of the alternative reality that is, I think, a real possibility here. And the bottom line is, I think, really this. You've got this historical seasonality that we need to be careful about right now. We've got a lot of circumstances that are lining up, particularly analog with 1987. And we're also in a technical position where the market is poised for a third wave decline. And if we're correct about our technical analysis, if we're correct about the cycles, if we're correct about the macro backdrop, then I think there's a real risk that we could see a plunge in this September into October period. Perhaps it's September 14th to October 14th. Maybe it carries to October 28th, maybe somewhere in between. But we think those are important dates to keep in mind. And we think the risk is to the downside during this period. So we would not throw caution to the wind.
So you've given us the dates. How about would you mind running us through some of the technical levels that you're seeing? I know we've been through these in the past, but are there any major changes since we last spoke?
No, we use the Elliott Wave principle to kind of, walk through and kind of, determine where we are in the process, right? And the chart we're looking at right now dates back to, the market's all-time record high on January 4th of 2022. And we could see that the, initial decline into the October lows of last year traced out 5 waves down. And, we've identified this as a textbook pattern from Frost and Prechter's seminal 1978 book, The Elliott Wave Principle. And that textbook pattern is a expanding leading diagonal pattern. And so, there are 2 types of leading diagonals, a contracting and expanding. This is the expanding variety. It is very much a textbook pattern. And we think that probably is wave 1 of a 5-wave impulse pattern that is in its early stages. We think that it's a very large degree. We're using primary degree of trend to illustrate where we are in this process. We think the rally off those October lows into the July 27th high was primary wave 2. It was a zigzag Elliott waveform, corrective waveform, tracing out an A, B, C. It was quite an epic, counter trend advance, if you will, because it had a couple of curious nuances to it. The B wave traced out a very large pattern that's known as a flat pattern, and so kind of threw us for a loop initially. We did not catch it until after the breakout above the February 2nd high, and then the C wave of that same pattern had an extended 3rd and an extended 5th wave, which made identifying the top of this somewhat elusive, especially since it exceeded all the Fibonacci retracement levels that we would normally point to, like a 38.2 or a 61.8% retracement. Even the 2/3 retracement and the 7/8/6 retracement were exceeded. In fact, primary wave 2 retraced a full 84%, but it retraced just shy of the second wave at intermediate degree of that initial primary wave 1 down. And that is not uncommon for a retracement of an expanding diagonal pattern. And one of the reasons that we didn't think of that at first is because there's only been 2 that have been identified in history. So this is looking at the entire history of the tape. There just aren't a lot of prior examples to point to at this degree of trend. And so we feel like we've got the Rubik's Cube solved at this point. We think wave 2 topped on July 27th, and the decline since then traced out 5 waves down at a minor degree of trend. And we've thus seen a 3-wave advance off that August 18th low, which looks to us to be minor wave 2 up, a counter trend advance. And that should be followed by minor wave 3 down. All of this should ultimately trace out the impulsive waveform that we expect to materialize that will ultimately be primary wave 3 down. And we believe primary wave 3 down can carry deep into, say, S&P 2700 to say as low as perhaps S&P 2400 before it terminates. We think we're in the very early stages, Mehdi. And in fact, we've drawn some lines in the sand to help us kind of gauge where we are. And the first support level that we're looking at is S&P 4335. That's the August 18th low. Once we break below that level, that will confirm that we are now in the next phase of decline. And we think that that decline should carry down to the next support level, which kind of comes into play at around 4,200, 4,100 range. 4,200 kind of marks the February 2nd high. 4,100 marks the December 13th high. And that is the wave A high of that counter trend advance. Once we penetrate 4,100, that rules out any other bullish possibility in the wave principle. And therefore, we would believe at that point it confirms definitively that primary wave 3 down is in progress. And that would be a reason to be extremely bearish and out of the market entirely because third wave declines are dynamic. They are powerful declines. And we think we're really on the precipice of seeing that price action. So we're advising clients to really minimize net equity exposure, maximize cash reserves, and really stand aside and let this thing play out.
So that's quite the picture you've painted there. Thank you for running us through all those levels and your thoughts around that. What about the market internals? They're not looking great either, are they?
They're not, and this is part of the supporting evidence, right? We use Elliott Wave, but we're using evidence-based technical analysis, right? So we're looking at things like breadth, momentum, net advancing volume as key internals for the S&P 500, and breadth has been punk for some time now. Last week, I think net advancers were about 5% of the S&P 500. But more importantly, we've seen each and every recovery advance terminate at a lower high, which has left a series of negative divergences in place from where the market peaked. And that's typical when we're at a major trend change, right? The same is true of momentum, right? Momentum peaked and then it put in a lower high on July 27th as the S&P's price action peaked. That negative divergence preceded the initial decline down, and momentum has penetrated the median line, indicating that we're in kind of a bearish regime for momentum. Now we've rallied back above the median line and continue to hold there, but just barely above the median line. And so my suspicion is that we are in a bearish momentum regime. And when we look at net advancing volume, we did not see a powerful move last week, in terms of upside volume or downside volume. But the most important thing is that if we look at the 5-week moving average of net advancing volume, that's up volume divided by down volume, it's about 1.5 to 1. That is very, very weak. If we were in a sustained bull market, I would expect to see that at around 5 to 1 or better. So we are not impressed by the internals at this point.
What about the investor sentiment?
Investor sentiment continues to, kind of be weak from its kind of extreme levels. So, looking back at the July peak, we saw the name exposure index. This is the 2-week moving average of survey respondents in the National Association of Active Investment Managers survey, right? And so, these are professional investors, tactical investors. And at that extreme, they were 101% invested and they were actually leveraged. We saw that decline down to around 34% 2 weeks ago. And it has subsequently bounced up to around 49.7% as of last week. That just, to me, looks like a bit of a dead cat bounce. It's the minimum sort of level for neutral is 50%. And so, we're just slightly below 50% right now. If we look at individual investors, this is the American Association of Individual Investors, AAII survey. Bulls are coming in around 42%, bears around 30% at this point. We're around 12.5%. The bull bear spread that is up significantly from negative 3.6% 2 weeks ago. And so, again, we've recovered in terms of that investor sentiment from from lows that were not necessarily extremes. I might add, the extreme on the AA was negative 40% last October. So -3 is negative, but it's not an extreme, right? The extremes in the AAII got down into like 20% range last October. And so, we're at points that they're well above the extremes. We do not think that these are indicative of a market low. We think that they're more indicative of a dead cat bounce within a downtrend. And so that's kind of how we're looking at sentiment. Net, I would call it neutral.
So much of the rally has been attributed to the Magnificent Seven, as they've been coined, and we discuss them week in, week out. At this point, are they showing a bit of signs of fatigue?
It's interesting. The biggest stock in the S&P 500 is Apple. Apple was down 6% last week. NVIDIA has been the best performer year to date, and really over the last year. And that stock was also down 6%. So these are the two darlings. And we think maybe it indicates that, some semblance of reality is beginning to materialize in investors' minds. Conversely, we did see Tesla and Microsoft advanced by about 1.5% each last week. And Tesla, of course, saw a big up move yesterday following an upgrade from, the analyst at Morgan Stanley, who's considered to be the axe on the stock. And so, at the end of the day, I think, we're seeing a bit of rotation within the Magnificent Seven. But I think the weakness in Apple, kind of coming into today's event, we got the big, annual sort of, pre-Christmas product release today. Everybody's talking about the iPhone 15. We'll see if it is enough to excite people about the stock again. In my mind, we saw Apple make a lower high, which looks to me like it's the beginning of the next move to the downside for Apple. As far as NVIDIA, I think the stock's probably topped. And Tesla, I think, yesterday, the bounce that we saw, doesn't even get it anywhere near its all-time highs of 400, even though the analysts put that out as a target price. The stock really just continues to look weak to me. This all continues to look counter trend. And so I would not have a lot of confidence in that move as being something that can be sustained.
So, Jeff, let's have a look at some sectors here. Can we have a look at, as we've been doing over the last couple of weeks as well, like a valuation analysis, some of the sectors that you like, and then like a relative strength analysis as well, because that gives a good picture on everything.
Yeah. So first, let's just talk about strength last week. We saw energy and utilities were positive. They were the only two sectors in the S&P that put up positive returns last week, roughly about 1%. I think energy is up maybe 1.4, Utes slightly below 1%, but both positive. The flip side was tech, industrials, and materials. The cyclical sectors of the market were all down around 2.5%. So it does seem to be like, there is, again, a shift. The bear market's beginning to power up. We're seeing relative strength of some of these, defensive type sectors, led by healthcare for the most part in the last several weeks. It wasn't necessarily strong last week. It wasn't weak. It did outperform, but it was negative last week. But I would say that we're starting to see some ebb toward defensive sectors, and energy really dominate here. And that's kind of where I would go. I mean, we've been talking about valuations favoring energy. It's the cheapest sector by far and away on a forward PE basis. Tech, on the flip side, is the most expensive, and so we think that fade tech, press the long on energy is really kind of the trade that we've been looking at from a fundamental perspective that makes the most sense. From a relative strength, pure relative strength perspective, energy continues to stand out within the 11 GIC sectors in the S&P as exhibiting relative strength leadership and very strong momentum. And so, we continue to favor energy as our top ranked sector. We haven't given up on industrials and materials just yet. We do think that there is an infrastructure trade that is funded for the next several years. And we think that those stocks will be outperformers on a structural basis. But in the very short term, cyclicals could come under pressure, and they would be defined, no question, as cyclicals. Energy might be a bit of a safe haven, just given the supply demand dynamics right now that exist in the market and that positive correlation that's showing up with rates and the dollar. For all those reasons, I think energy can continue to hold its relative strength.
And there's a lot of
leadership.
news flow that seems to be supportive of that trade as well on the energy side. Jeff, as always, really appreciate you sharing your thoughts from Alpha Insights.
Oh, my pleasure, Mehdi.
And I want to thank our viewers and urge you to check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.